Okay, Assalamualaikum warahmatullahi wabarakatuh. Okay, the next chapter is dividend policy. So basically for this MAF 603, dividend policy is a new topic. Okay, right. So we go to the next slide. Okay, the chapter outline of this topic is about dividend decision, and then dividend irrelevance theory, which is what is it introduced by Modigliani and Miller. Okay, dividend residual theory, right? Relevance of dividends. So relevance of dividend will be covering birds in the hands theory and the clientele effect, right? So the next one, dividend signaling, stock repurchase, and scrip dividend or scrip issue. Okay, right. For dividend decision, right, for the first part, as the introduction, the question is, what is dividend? Okay, so I think you are familiar with the words of dividend, especially cash dividend, right? So a dividend is distribution of the portions of the company's earning, right, that is decided and managed by the company's board of directors. Okay, and then it is normally paid to a class of its shareholders. So if they have the preference shareholders, I mean previously if they have issued preference shares, that means they have the preference shareholders, and then ordinary shareholders. Okay, right. So it will be distributed to a class of its shareholders. It depends of the types of the shares issued by the company. Right. So dividends are payment made normally by publicly listed company as a rewards to investors for putting their money in the company. Right. So dividend as part of rewards to the shareholders because they have distribute or they have invested in the company, and provide fund for the company to run the business. Okay, so it determines what funds flow to investors and what is retained by the firms for investment. Right, the dividend pays may be treated as a signal to investors. So this will be relating to the signaling theory. Okay, and then the company needs to take account of different clienteles of shareholders in dividend decisions. So different clientele, that means different group of people or shareholders that have invested their money in the company, because different people or different shareholders would have different eligible or entitled, in other words, entitled to different tax bracket. Some shareholders have to pay low tax rate, and some investors may be paying high tax rate. Okay, right. In the situations of liquidating, when the company is facing a financial problem or difficulty in the uh, financial. So if the company distribute the dividend out of the capital, that means that dividend is called as liquidating dividend. And then dividend can be expressed in a dollar per share, right? Percentage of the market price, which is dividend yield, and then percentage of earnings per share, that is so called as dividend payout. Okay. Right. Before that, okay, so you must aware of that dividend is not a compulsory. That means it's not an obligation where the company must pay the cash or dividend to the shareholders, right? Uh, that means dividend is just an option to the company of whether to pay dividend or not from its net profits. And then the announcement of dividend payouts are normally or generally accompanied by a proportional increase or decrease in the company stocks price. Let's say if the company currently the stocks price of the company or company stock is trading at 2 ringgit per share, and then the company announced the dividend of 50 cents. So basically or generally the stocks price will increase to this information and how much it's going to increase. So they estimate it will increase by the amounts of dividend. So that means the stock price may be going to be 2 ringgit and 50 cent. Okay, if the dividend is 50 cent, if dividend is 20 cent per share, that means the share price going to increase um, by 20 cent, becomes 2 ringgit and 20 cent. And after dividend is paid or distributed to the shareholders, so the share price will decline, and also it will decline by the amounts of um, dividend amount. Okay, so it goes back to the price before the dividends announcement. Okay, right. The importance of dividend policy. Okay, under this part, it shows the relationship between dividend decision and financing decision. So it is a strategy in regard to the amount they would pay to their shareholders as dividend. Okay, and then the company has to determine what portions of earning will be paid out as the dividend to the shareholders and what will be retained in the business, right? And the firm actually has three options to decide what to do with the profits, or net profit. So it's either the company retain all the profit within the firm and no dividends paid to the shareholders, right? And then distribute all the profits in the forms of dividend to their shareholders. That means there's no profit retained within the firm, okay, for the future use. And then or the company can retain some of the profits in the firm and maybe distribute the remainder as dividend. The remainder is called as the residual amount. Okay, let's say if the earnings of the company, profits of the company is 1 million, maybe it will retain some of the profit in the firm of 800,000, and the rest of the balance of 200,000 will be the residual amount, which is 200,000, will be payable as dividend. Okay, right. So trade-off between dividend and retained earning. Okay, so there seems to be an inverse relationship between the retained earnings and dividend. So how is it? It means that if the company pay dividends, so there will be less amount retained in the company. So that means if the company needs additional fund um, for financing the company's activities or investment, they need external funding. So this will lead to higher costs, okay, whereby they have to pay expenses. Right, the decision to pay a large dividend would mean little amounts for retained earning for funding the growth. So the firm will therefore place a greater reliance on external funding for its investment. Okay, right. Secondly, if the company pay low dividend or small amount of dividend, so it would lead to higher profit retained, and as a result, it will reduce the reliance of the company on the external fund, okay, in financing the firm's investment, but it will make the shareholders unhappy, especially to those rely on the dividend income as their current income. So basically this is referring to the pensioner, retired people, because they don't have any other income, they just rely on the current income. That's why they need the dividend income. So this, if these shareholders is a majority of the company shareholders, that means it will affect the stocks price of the company adversely or negatively. Okay, next we go to the types of dividend. Types of dividend can be cash dividend, right, where it is paid out of the firm's profit to the ordinary shareholders, and it can be stated as dividend per share or dividend yield. So what happened then if the company pay cash dividend? That means the cash available will be become less, and retained earning also become less. So they will rely on the external funding. Okay, the next one, the types of dividend is stocks dividend or scrip issue, where new issues of shares to existing shareholders as dividend for free. So popularly known as the bonus issue shares or scrip dividend. It increases the number of shares outstanding. What's the meaning of shares outstanding? The shares outstanding refers to the number of shares issued by the company. So if they give bonus shares or bonus issue or stock dividend to the shareholders, existing shareholders, that means the number of shares outstanding or issued will be increased, and this one will reduces the value of each shares. Okay, and another way that company can pay dividend is in the form of stock split, right? It will increase again the number of shares outstanding. So stock split occurs, for example, so this is the example when each ordinary shares of 1 ringgit each is split into 2 shares. That means each shares become 50 cents. So therefore, it creates cheaper shares with greater marketability. Right, investors, that means investors may expect the company to which splits its shares is planning for substantial growth, right, and dividend growth in the future, because they are not receiving cash dividend, right? So they expect the company make use of their money efficiently or wisely. Okay, so the stock price will drop after the stock split. So that is the normal or general effects on the stock price when the company make stock split. Okay. All right. Before we go in detail about the theory of dividend, we need to know what is the dates describing the generally chronology of a dividend payment. So that means the dates that you have to aware of. Excuse me. Okay. First of all, we will go to the declaration date. Right, declaration date or the announcement date. So the announcement date is what? The day the board of directors announces its intention to pay a dividend at the AGM, and the board will also announce the date of record and payment date. Okay, so in dividend date or come dividend date is the last day before the ex-dividend date. Okay, on this in dividend date, that means the buyer will receive the dividend, whereas the seller will lose their right to the dividend. So that means if they are buying the stocks of the company within the dividend date, in dividend date, right? So that means they are entitled for the dividend payment. Okay, right. The next one, ex-dividend date. Right, so ex-dividend date is the day on which all shares bought and sold and no longer come attached with the right to be paid the most recently declared dividend. So they have to wait for the next year's dividend, if there is any. So that means they are not uh, entitled to the dividend payment for this year, because they bought or purchased the stocks of the company on the ex-dividend date or after the ex-dividend date. Right, they become the shareholders of the company, but then they are not entitled or eligible to the dividend payment for that particular year because of the ex-dividend date transaction. Okay, the next one, date of record. So date of record is the dividend is payable to the shareholders whose names appear in the register of member as on the record date. Okay, that means date of record is the date where the list of the shareholders, right, produced by the company who qualified for the dividend payment. Okay, right, and then payment date, I think you know this is very clear. The payment date is the day when the company actually mails out the checks to the shareholders listed on the register of the members who are listed on the record. Okay, members on the record date. Okay, all right. Okay, right, so this is the procedure of the cash payment. Okay, cash dividend payment. Okay, I think I have to click. All right. Okay, so let's say declaration date is 15. The board of directors declares payment of dividends on 15 June. And come dividend date is one trading day before the ex-dividend date, right? Is entitled dividend for both existing shareholders and for the new shareholders lah, buyer. And ex-dividend date is the trade on or after ex-dividend date. right? If the investors buy the shares of the company on this particular date, that means they are not entitled for dividend, to dividend for the buyer. Okay, record date is where the corporation prepares a list of shareholders as per register of member. So